please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Time now to have our market master joining us. Mahesh Patil, Co-Chief Investment Officer at Aditya Birla Sun Life AMC is with us. Mahesh, good morning.
Yeah, good morning.
How have you viewed the recent mid-cap correction? Of course, there's been some stability over the last couple of weeks. And has that presented top-up opportunities in your existing stocks, or is it time to sort of relook at the portfolio and perhaps get a bit more narrow?
Yeah, I think year till date, if you look at the divergence between, say, the Nifty and the mid-cap index, and especially the small-cap index, has been huge. In fact, if you look at the BSE 500 companies, there are 250 companies where they have fallen at least 25% from its peak. So there has been a significant correction in the small cap and the mid cap space. And for the first time, actually, we are seeing some good opportunities of value emerging in some of the small and mid cap names. Obviously, there are many stocks which went up last year because of the huge liquidity, stocks without fundamentals or without any major kind of drivers. So those stocks, I think, would not probably go up. But there are decent companies which have corrected because of liquidity has kind of slowed down into that space. And if one takes a slightly longer term view, especially at a time when we see the economy kind of getting some momentum, and a lot of these sectors, whether it's in the infrastructure sector, the consumer durable sector, and building materials, where the outlook going forward looks fairly good. And normally in an economic recovery, when growth starts to pick up, we see some of these mid and small cap companies tend to report better earnings growth than the large cap. So I think the P multiples had expanded significantly in the last year or so. The recent correction in the mid cap space, and also the fact that earnings growth likely to catch up in some of these stocks. I think it will be a good idea to add selectively in the small and mid cap space, and we are looking at those opportunities. Again, mind you, the market still has some kind of headwinds. We are not in a kind of a major big upturn. So there will be corrections in the market, and mid and small cap sector will remain volatile. So investors should be aware of that. But I think it's a good time to start building a portfolio in the small and mid cap space, say with a 3-year view.
Okay, good time to start building a portfolio. By the way, don't lose sight of what's happening in Asia. It's really a volatile ride over there. Trade concerns have simmered, but you know, there's so much retaliation happening from all over the place. Look at Hong Kong. It's now 400 points off from the high point of trade. Where just an hour back, we were talking about how Hong Kong was a tad bit in the green, and now look at where that has fallen off a cliff.
That will happen, you know, if you're chasing market on either direction right now, Sonia. Also, the dollar index, we're talking about that. So dollar rupee has also come off a bit. It's going to remain like that, this market. You know, every day. 2 days back, Hong Kong was up 900 points. You know, we were worrying, you know, what's happening. Yesterday it was up quite a bit. Today it's like that. Some of these markets, you know, if you see the charts, they are like, you know, the IFCIs of the world or CG bars of the world. Intraday charts are, you know, like individual stocks. It's really all over the place.
That's why yoga, right? That's why yoga. All right, but getting back to our own markets, the stock of the moment now is ICICI Bank, definitely 1.5% higher, and it has given you quite a bit of returns just over the last, you know, 5-10 days or so. Mahesh, there are corporate lenders who are sort of seeing some recovery as far as their book is concerned. Is this a time to be buying? ICICI Bank, of course, has other positives as well, like a complete cleanup of the leadership, etc.
Yeah, I think on the corporate bank side, yeah, clearly we've seen a large amount of recognition of NPAs happened in the recent past, and that has led to an impact on the P&L and the ROEs and the ROAs, which I think will continue for some time, at least the impact on the P&L for at least this year and partly for the next fiscal year. But I think overall, the good thing is that at least the magnitude of stress on the corporate book is pretty much in sight. We're not seeing any further increase in stress overall. There are some kind of issues on the power sector where you would see further recognition of that in this year. But that amount should not be, say, more than around 50,000 to 1 lakh crores or so. So given that and the fact that we are seeing recovery in some of the sectors which have been stressed, like steel, and overall growth pickup, I think I mean, looking at the valuations in some of these corporate banks, I mean, there's a big divergence again in the banking sector, retail banks and the corporate banks. I think there is some a case for some kind of a re-rating over the next 2 to 3 years in some of these corporate banks. So if one takes a slightly longer term view, I think as the credit costs go down, which we think will happen in some of these larger banks, as the ROEs tend to inch up towards 15, 16 kind of levels, I think, yeah, there is a decent upside coming in from not only earnings growth, but also some kind of a re-rating in some of these corporate banks.
Okay. Mahesh, I'm guessing pharma is now becoming quite a case for managers like yourselves, right? Because there's so many things that are going in favor. Companies are sounding positive, approvals are coming through. I mean, we just were speaking to Lupin yesterday. They were saying worst of the pricing pressure should be definitely over. There is a rupee tailwind. So, I mean, one can build up a huge bull case. The question is, are you convinced, and would you be looking at increasing pharma holdings across the funds?
So you're right. I think the pharma sector, again, one of the laggards in the industry, and seen a significant correction in terms of earnings. Yeah, but I think recently we've seen some positives coming in. At least the negatives are looking to be behind. So I think the sector clearly has bottomed out both in terms of earnings, and you will see a recovery in the, I mean, partly in this year, but major in the next year for most of the companies. And so I think while at the margin things are turning a bit positive, I mean, we're not seeing any major tailwind for the sector coming in, say, from the US. Yeah, obviously the pricing pressure in the US has kind of eased off. So compared to around 10% kind of a decline for the core business, it will probably be in the low single digits. So that is one case. But I think the domestic pharma industry is looking in a much better shape. We are seeing decent volume growth, and also the regular pricing, because of which is linked to the WPI, is enabling companies to take price increases, and that's more like a stable secular growth story. So overall in the sector, I think it still remains stock specific. We have seen some rally from the bottom. There could be some disappointments in 1 or 2 quarters. It's not like you will see an immediate improvement in earnings, but I think it will provide opportunities to really build in that space. And yeah, I think after being negative for some time, I think we are seeing positive green shoots coming up in the pharma sector.
Okay, the stock which is really looking interesting right now is Infibeam, because there are many block deals which are happening, and if you look at the website of NSE and see the depth of the stock, there's quite a few which are pending now. So it looks like there's going to be more and more block deals now on Infibeam. It's happened mostly around 151 to 152. So that big bar that you saw was on account of that block that took place at 151. So let's perhaps just pull out the block deal data if we have and see the block deals which have taken place. I think I can see 4 block deals right now. Yeah, there they are. And decent, about almost 0.5% of equity so far on Infibeam. Let's see how things move from here. So Mahesh, for this year, the big call for retail investors is after last year, and last year would have led a lot of people to invest in the bad apples, right? And on an average, some stocks are down 40 to 50%. What should they be doing this year in the market? Should they be averaging some of these stocks, or as we've seen the markets become a bit narrow, quality stocks have become more expensive, should there be a shift towards these stocks?
Yeah, I think as the liquidity has kind of slowed down, I think we are seeing clear differentiation in terms of, I mean, companies where there have been fundamentals and companies which have just gone up because of liquidity. Again, within that, as you rightly said, some of the quality stocks, the multiples have really expanded, but there are many companies even in a decent quality or in the mid and small cap space where the correction has happened and where the earnings growth or the fundamentals are fairly sound. I think it's time to look at some of those stocks, and which I mentioned earlier. I think there is some value emerging in some of the small and mid cap space. But having said that, again, I think the recent fall, I mean, the correction in the market, and especially in some of these small cap and mid cap stocks, has clearly again highlighted the fact that for retail investors, getting directly into stocks, especially down the curve, okay, where the risk is higher, I think the correction and the loss can be significant. And we've seen stocks tumble, I mean, by 50, 60 or 70% where there have been some corporate governance issues. So I think it's, I mean, it's important for some of these retail investors to then come to the mutual fund route, really, especially in the small cap and mid cap space, where right kind of a diversification, right kind of stock selection is important to really protect on the downside when there is market correction.
So some of those spaces, I was looking at your infra fund, you have some very interesting stocks, Honeywell, Crompton Greaves, PTC India, etc. I mean, some of them have not done anything this year, but for the long-term investors, you think there's still potential here?
Yeah, I think especially in companies like in the power sector, we haven't seen much of an improvement over there. There again in infrastructure sector, there has been some kind of a pickup in the power T&D side where we are seeing order inflows come in. Again, the broader recovery in the capex side is still some time away, but there are some green shoots coming in the capex side, which should lift up some of these capital good companies. And then on the construction, urban infrastructure, road construction, I think the order book is fairly good. Execution as this picks up, you should see earnings coming through. So I think overall on the infra space, yeah, I think the recent correction has provided a good opportunity in some of these stocks. Valuations have come down to more reasonable levels, and we are seeing a decent pickup in growth in this fiscal year. So a lot of the mid and small cap names, the growth in FY19 looks to be much stronger than the broader Nifty, which is somewhere around 18-20%. The mid and small cap, at least in our universe, we are looking at a growth of around 23-24%.
Okay, speaking of mid and small caps, by the way, the market's cooled off quite substantially. Mid-cap index actually turned negative. There's plenty of selling on quite a few stocks. Some of your ASM names like Rain Industries, Bhansali, Avanti Feeds suddenly down 3.5%. Even a stock like Jubilant Foodworks has come under some stress. There's a lot of selling, profit-taking rather perhaps in pharma. Watch out for the large cap names like DRL, Sun Pharma, also something like Glenmark. Many of these stocks under pressure. Mahesh, a quick final question to you. How are you now looking at consumption and sort of the calls that you're taking in that sector?
Consumption has, I mean, it's been a more of a secular story in India, right? So it's a question about getting the right stocks at the right valuations. Recent numbers which have come in from the consumer pack are pretty encouraging in terms of pickup in volume growth. We've seen a lot of these companies have got the benefit of GST and have seen some improvement in the margins, especially in the other costs, despite some commodity inflation, what we have seen. And I think the full benefit of GST will come through in the coming years, be it on logistics or other areas. And I think rural consumption is showing sign of pickup, though it's not as strong as what we are looking forward. But looking at this year, where we're seeing a stronger focus by the government in terms of rural, trying to double farm incomes. Also, the monsoons have been good. So I think the sector should be fairly steady. At least there is visibility in terms of steady growth in that sector. Valuations, again, are expensive in a lot of the consumer names. But consumer discretionary is offering an interesting opportunity. We've seen some correction in this name. There has been some, I mean, some of the companies post GST have still not really come back to the growth rate, potential growth rate. So I think within the consumption space, consumer staples, while the outlook there is good and steady, valuations expensive, consumer discretionary offers a better entry point. And as the per capita income goes up, as the penetration level, rural penetration increases in some of these categories, I think one can expect a stronger growth in the coming years over there.